Global Financial Impact Review, July 30th, 2026. After the Fed met yesterday, here's the straight, no-fluff breakdown of what actually matters to consumers, business owners, and families right now. The Fed did not cut interest rates. They held rates steady again, and that tells us something very important. Inflation is still not under control enough for them to start making borrowing cheaper. That means if you are waiting for credit cards, mortgages, business loans, auto loans, or lines of credit to suddenly become affordable again, that relief is not here yet. Now here's the good. The economy is not collapsing. Jobs are still holding up, consumers are still spending, and the market is still finding areas of strength, especially in technology, AI, and large cap companies. So this is not a panic environment. But here's the bad. Inflation is still hitting people where they actually live. Gas is back around $4 nationally. Food is still expensive. Utilities are still elevated. Insurance costs are up. Housing is still unaffordable for a lot of families. And even though the headlines may say inflation is cooling, the consumer does not feel relief when their grocery bill, gas tank, mortgage payment, rent, and credit card statement are all still high. Now here's the ugly. The Fed is trapped. If they cut rates too early, inflation can heat back up. If they raise rates again, borrowing gets even more expensive. And if they hold rates where they are, consumers and small businesses continue to deal with higher debt costs. That is the squeeze. For the average household, the biggest danger right now is revolving debt. Credit cards, personal loans, and variable rate debt are still dangerous. If you are paying 20% or more on credit cards, that is not just debt. That is a wealth drain. For home buyers, affordability is still the problem. Prices are high, mortgage rates are high, and sellers are still reluctant to give up lower existing mortgage rates. So the housing market is stuck in a very uncomfortable place. For business owners, this is not the time to guess. This is the time to review cash flow, debt structure, access to capital, succession planning, key person exposure, and whether your business can withstand another 12 to 24 months of higher borrowing costs. So what is really relevant to the consumer? Number 1, stay liquid. Number 2, reduce high interest debt. Number 3, do not overborrow emotionally. Number 4, protect your income. Number 5, review your retirement and insurance strategy before markets or life events force you to make decisions under pressure. And number 6, business owners need to stop treating continuity, buy-sell planning, key person protection, and access to capital like optional conversations. They are not optional anymore. The bottom line is this: the economy is still standing, but the consumer is under pressure. Inflation is not gone. Rates are not coming down fast. Housing is still difficult. Credit card debt is dangerous. And business owners need to protect liquidity before they chase expansion. This is not a time for fear, but it is absolutely a time for discipline. That is this week's Global Financial Impact Review.